And let me discuss the risk and realities of position trading you need to consider. The risk and the realities of position trading that you need to be familiar with. And while position trading, offers several advantages, it also comes with some disadvantages, just like every other investment strategy. They have advantages and disadvantages. So number one here is longer exposure to market risk. Longer exposure to market risk. So holding positions for extended period exposes traders, to potential market downturns, as they are more susceptible to large price swings over the long term. The longer you hold an investment, the longer it compounds, and the higher it compounds, and at the same time, the more you are getting yourself exposed to market downturns. So that's just the way it works. As your stock is compounding in value, at the same time, it's equally getting exposed to market downturn. Number two is then slower to capitalize on opportunities. Slower to capitalize on opportunities. Position trading may miss out on the short-term opportunities as they are not actively monitoring the market for quick trades. That's it. You get to miss out for opportunity because you are fully invested in a particular stock. You set blinkers around yourself so you don't get distracted by what is happening around you in the market, and opportunity cost set in. Opportunity forgone. You discover that you may lose sight of probably better or excellent advantages or opportunities around you. So there's that particular slower rate of to take advantage of opportunities. Number three is requires patience. It requires patience when it comes to position trading. Patience is key. Position trading requires a lot of patience, as traders need to wait for their position to reach profitable level over time, which might be frustrating for those looking for quicker returns. If you're looking for quicker returns, I'm afraid this particular strategy is not for you. You don't get that. You don't get that, So number five is market volatility impacts. Market volatility impact. Long-term positions are vulnerable to periods of higher volatility, which could lead to significant drawdowns, particularly in times of economic uncertainty or market correction. Generally, the market would always correct itself, and this correction provides a kind of exposure to it could expose the investor to significant losses if care is not taken. Number six is emotional challenges. Emotional challenges. So holding positions for long periods can lead to emotional stress, especially if the market moves against the trader's position for an extended time, tempting them to exit prematurely. I think this is the most critical disadvantages of position trading or buy and hold investing. You will encounter a lot because the typical graph of the stock market doesn't go like this, or of a stock price does not go this way. It goes up and might even nosedive and then travels up again. So all these points where the market or the stock drops very low. It's kind of stomach churning. It's emotionally stressful, and these are what you're going to be exposed to for as long as you hold the stocks. It might be a year or two or even three, whatsoever. So be assured of the fact that you're going to pass through these circumstances while you hold the stock. Is a typical disadvantage of position trading. It involves emotional stress. Sometimes your stock could be down as much as 30, 40%, if not 50%, before it climbs up again. In all those circumstances, you discover that really is very, very, it could be quite painful. It could be quite, psychologically taxing and stressful. These are what you need to actually consider as a positioned trader. Number 7 is lower liquidity. Lower liquidity. Position traders may experience lower liquidity in certain assets, particularly if they are holding positions in smaller or less liquid markets, making it harder to exit position without significant slippage. So in a case where there's a lower liquidity, it may be very difficult for you to exit your position without significantly affecting the stock price, or you may not really exit at the price you want to. Okay, you may exit at a lower price, which of course, because of a factor called slippage. Slippage is you exiting a position at a price you don't really want to exit at, but because that's what the market presents to you, that is the way it is. Number 8 is overlooking short-term trends. Overlooking short-term trends. So number 9 is higher capital requirements. Since position trading involves holding assets for extended periods, it may require a larger initial investment to manage the risk and maintain position through market fluctuation. So there's higher capital requirements. Because you want to really enjoy this particular strategy, you need a large capital outlay. You need a large initial capital, so that whenever the stock compounds in the near future, you will get to benefit a lot. So position trading might not be suitable for everyone, particularly those looking for quick profits or those unable to tolerate extended periods of market fluctuations. If you can tolerate it, fine. But if you're not emotionally strong enough to be able to bear the stress involved, it's advisable you go for a kind of short-term investing. Or on the alternative, when you invest in the market, don't look at the market constantly. Don't evaluate. Don't pay too much attention to your portfolio. Don't be so keen about knowing what is happening in the portfolio, because sometimes what you are seeing there might really disturb you a lot. Okay, so if you're looking for quick profits, this is not for you, and that's the way it operates. So these are the typical demerits of position trading.